Okay, it's about 9 o'clock p.m. on February 3rd. Let's talk a little bit about market action and positioning, as usual. The positioning here indicates that the rebound that's going on in assets should continue. Let's start with, as usual, the dollar. Okay, British pound. I mean, look how short they are, British pound. And just take a look at what the British pound's been doing. You know, I mean, they were started getting mega short, obviously here, and now it's ripping in their face. The squeeze is on. Once the squeeze is on, the squeeze is on. They're going to have to cover those shorts. They're going to be forced to stop. It's just going to be taken out. Boom, 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 boom. Canadian dollar, which we've talked about also, same thing. Look at how short they are, and it's on. You know, so they started getting short. Squeezes on. Same thing in the Aussie dollar. I won't bore you with the details, but it's the same thing with the Aussie dollar. And the yen, which has been a little bit of a surprise to me, although we did catch the short, I didn't think, I wouldn't have thought that the yen would have rebounded so hard off of this Bank of Japan move short. First couple of days, you know, get some of it back, but today sort of surprised me. I know it was a whole dollar sell-off, and the yen is a big part of the dollar index, but there's still, you know, arguably still long yen, so there's more work to be done. So again, that's another risk on trade, you know. So the currencies are clearly showing, you know, risk on. The euro and the Swiss, you know, is neutral positioning, but they're going up too because, you know, the dollar's going down. But clearly, you know, the Aussie, the Canada, I mean, these are big commodity currencies, obviously. It doesn't last a very long time where these go up and commodities go down. Sure, a couple days, but over time, you know, they're very highly correlated. So that's risk on. Let's look at the bonds. What I've talked about in the bonds before is that the market was way too short, the short end, and more neutral, the long end. And that being long, the short end was the play. Clearly being long the short end has worked, but so has been long the long end. The short end didn't outperform or anything like that. But because we had the long end more neutral, and now the market has rallied, if you look, it's tough to tell here, but this red line is the large specs, and this is as of last Tuesday, which is a good week ago now. You know, this is the longest they've been, all year, 10 years. And we had a beautiful reversal day today on the 10 years on what was bearish economic news. And we're starting to hear a lot about, obviously, all these countries that are doing negative interest rates, and the U.S. is next, and, you know, all that. So people have gotten a little bit nuts on the fixed income. I think the 10 years are short right here, right now. Short it right now against, you know, today's high. Stop out at today's high. That's the trade. Short end's still a buy. So if you put that together, you know, you're going to be short the longer end and long the short end. That works. You know, that's a that's a steepening trade, which obviously is also, you know, bullish risk assets. So we have a dollar showing bullish risk assets. We have fixed income showing, you know, bullish risk assets. Crude, you know, again, talked about that crude speculators were not getting mega short, but this is at least a long they've been in over a year, which was right down here towards the bottom. It's rebounded. It hasn't rebounded as much as everything else because, you know, there's just not enough shorts there. We talked about unleaded. And this gets to the positioning point. You know, unleaded was where I've talked about that speculators are mega long unleaded. And someone I'm sure can explain to me fundamentally why unleaded was making new lows here and is the weakest one of all the energies. But I'm telling you, it's because on a positioning basis, this is where they are the most long, so therefore it's underperforming. I'm not going to argue that crude on the risk thing is a risk asset positive necessarily on a positioning thing, but clearly with the crude people being the least long that they've been, and if risk assets are going to go up, crude's going to go with it, especially with the dollar and that whole trade. Stocks are neutral, so again, there's no edge really. It means to me that they could go up or down. Obviously, as always, I've got no axe there. But should they go up, since they're starting neutral, should stocks go up, they're going to start getting long again. And that's what we'll be selling it. But again, I don't know that they're going to do that, but let's see if they do. When they do, we will sell. So when you put it all together, Oh, and the metals too. If we get to the metals, which we've talked about, they're mega short palladium, right? It's going up. They're mega short platinum. It's starting to go up, and the squeeze is on all these things. So all these shorts are going to get. You would think you're going to get squeezed here, which is going to cause risk assets to go up. So that goes against the whole macro thesis of the world is coming to an end, we're going through deflationary spiral, blah, 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 although it doesn't go against the thesis that there's certainly going to be, sharp bounces here. It seems to be what we're in the middle of here. But, the thing about the macro view is I don't take a macro view and then put on the positions that match that. I look at the positioning, that which trades are probably have a high probability of working, and then figure out the macro thing that is going to make those trades work, right? And again, with the positioning now, we're looking at things should be friendly towards risk assets, including a yield curve, a yield steepening. So the whole macro thing about the world coming to an end is that if you have a macro view and you get it right, you should make a lot of money. If you have a macro view and it's wrong, you should also make a lot of money. We're trading the markets here. We're not trading the economies. We're not trading our macro views. We're not looking to be the top analyst, an institutional investor. We're looking to make money no matter what happens. And right now, the risk on trade is that. And look, if they get squeezed out, if they start getting long, if everyone starts getting bullish again, I'll be the first one on here to come back to, hey man, there's a deflationary spiral and the velocity of money is no good, and let's short everything. But for now, risk on seems to be something that is going to continue here. So let's trade it. Let's make money, and we'll see what happens when the data keeps coming out. All right.